With the new capital gains tax that's coming down, you stand to lose potentially up to 1/3 of the net profit you make when you go to sell your business. Absolutely terrifying for most people. Let's dive into how I can help you avoid that legally. I don't know why I did that. It should be legal, but hey, I'm not a tax accountant or a tax lawyer. So make sure you talk to your person, because this is not official tax advice. This is just one YouTuber's perspective that talks about buying and selling businesses. Anyhow, I've ruined that hook. Let's dive into the video. Hey everyone, it's Greg here. And in this video, we're going to dive into the timing of this capital gains tax. It's come out a few months back and now it's moving through the House in the USA. And by the way, if you're non-USA, this video doesn't really matter to you, but still watch it for the Google YouTube algorithm, almost a Google algorithm, but that too, that helps me. But we're going to be talking about the timing, kind of the structuring of this thing, and what you can actually do to minimize or maybe even completely avoid the taxes you pay on selling your business. So what is the tax proposal plan? Basically, and I'm not going to go into all the fine details of this. If you want the fine details of it, we actually wrote a blog post on this subject that I'll leave down in the description below if you wanted like the nitty-gritty stuff. This is more like the TLDR version, too long didn't read version, right? So basically the basic plan is long-term capital gains and short-term capital gains has always been this two-sided thing, or not two-sided thing, but the two different phases that an investor can get paid out on their investment when they sell. Usually this is related to stocks or real estate, all that kind of stuff. But it's also related to selling your business, whether it's an e-commerce store, a content site, a SaaS business, whatever, right? So the basic premise is any asset you hold for lower than 12 months is taxed at an ordinary income rate, versus something that you have above 1 year or longer than 1 year is charged at a long-term capital gains, which traditionally is capped between 20 and 25%. Now that percentage could go all the way up to 40% with this new tax proposed bill, depending on the state you live in and the type of accounting you're in and all that kind of stuff. Again, read the article down below. But that is a huge pressure for entrepreneurs right now who are wondering, what am I going to do? How am I going to sell this business and get what I want, right? Well, unfortunately, there isn't a whole lot you can do. Now, there are a few things. For one, the bill might not even pass. And basically the retroactive date of this, I believe it was like September 13th. So even if you sold right now, there's a good chance you're gonna be part of this, which is good to know going in that you might have to pay upwards of 30 to 40% when you sell your business. So what can you do in this situation? I mean, your hands feel kind of locked in handcuffs, right? How can you placate the tax man legally while still trying to get as much value out of your business as possible when you decide to exit or use that equity you have in that business in some other fashion or form? Well, first, let's talk about something that most investors never thought about doing before this bill was even proposed. Selling early, selling your business within 1 year, or selling your investment. Maybe you buy a business and you only hold it for 6 or 8 months rather than 14 to 16 months, because at the end of the day, it doesn't matter. You're going to get taxed at a similar rate, whether it's long-term or short-term capital gains at this point. So one thing you can do, this could be somewhat of an advantage for a business flipper, where you come in and buy businesses and then flip them within 3 to 6 months, because you just pounded all your conversion stuff up and you just grew that revenue very, very quickly. So there's that. You can shorten your timeline on a flip, because it's not really saving you money, but it's not really losing you money if you sell early now. So that is an option for people who really have their systems in place. But what can you do if you actually want to sell your business? So like I said, if the September 13th deadline is still held in place, then it's too late to sell outside of this tax law. It won't apply to you anymore, unfortunately. But there's a good chance that it won't stay that way, right? It'll probably be fought and it'll probably have a bunch of different caveats in there, and maybe a sale of a business will be one of them, while real estate and stocks get hit by this thing. You never know how these things will really roll out. But let's move into the very first strategy you can do in this situation. The first thing you can do is simply not sell. That's right. The way to avoid taxation is simply not selling your business. You can wrap it up as a gift, an heir, to your heir if you want, though there's problems with that with the new tax bill that's coming out too, where your heirs could end up just paying the tax anyway. So that that might not be a viable solution based off what happens when it comes to inheritance and all that kind of stuff. But a lot of rich people, a lot of ultra high net worth individuals, this is a viable strategy they use all the time. Now, usually it's not when it comes to selling a business, but usually it comes to their other assets, their other investments, such as real estate and their stock and their securities portfolio, right? Where they will basically just accumulate this a vast amount of net worth, and they'll put it in a stable investment, say like index funds, which are, arguably one of the most stable of investments. They'll obviously can fluctuate up and down. And if they need money, instead of selling their index funds, what they're going to do is take a loan out on their index funds, and they just use the loan and they pay it off from their business or whatever. That's usually the way the ultra rich are actually using money. It's basically loan money from their own investments, and that avoids them from ever having to actually sell the business or sell the investment rather. Now, obviously you can't really do that in selling a business, right? Even if you sold just a partial amount of your equity, you're still going to end up paying taxes. But if the actual exit event is not worth your while, say you need $1 million, or say you needed like $600,000. So if you have $1 million exit, then it might make sense for you, because you're still going to get that $600,000 even at a 40% tax rate. If you're in like one of the worst areas in the country before that is going to get hit by this thing, if it does happen, you're in an okay place to sell. It makes sense to sell. So what you need to do is really figure out your own taxes. What is the cost going to be at the federal level, the state level, and the county level, because all three of these can combine to become a pretty high level of tax for you, depending on where you live in the United States or in the world if you're an American. Because remember, if you're an American living abroad, you will still get taxed. You get a global tax. We're one of the few countries lucky enough to have this. So what you need to do is to plan your tax calculation costs into the final formula of what you're going to get, and ask yourself, is that enough? Is that enough for me to go through the hassle of paying these taxes in the first place that could change my life in a meaningful way? Can this get me closer to my personal or business goals? If the answer is no, then one of the things you can do is simply hold on to the business, take your distributions like normal, and just avoid the tax completely by acting like the ultra high net worth where you just don't sell. Obviously, that's probably not the answer you want to hear, but a lot of people are going to be in this phase. All right, so here's another way you can do it. And this is actually pretty effective depending on the size of your business. And that's simply using earnouts. So traditionally, most sellers do not like earnouts because obviously you want all that money up front. You don't want to take the extra risk of saying, hey, here's my $500,000 business. I will give it to you for $100K with the promise you pay me $400K over a period of months, right? Most sellers don't want that. They want the money up front. But in this case, you might actually want to get an earnout for tax reasons. So say you had a $800,000, $900,000 business. I believe the bracket starts somewhere around $1 million. So let's say you had $1 million business, right? And if you get paid all that $1 million up front, you're going to get butchered on taxes just because of the high likelihood of the new tax bill coming out and just destroying your earnings basically. So you can use an earnout to get paid just beneath that tax bracket for a period of time, right? So let's say it was $500,000, just to make the math simple. I don't believe it actually is that. Read the article down below to get the actual numbers. But let's say anything above $500,000 earned in a single year is an absolute terrible shit show for you when it comes to taxations. Like it would be way more worth it to earn $499,000 than to earn, say, $580,000 because of the taxation cost that is added onto that, right? So in this scenario, what you could do is do a earnout, where it's a 2-year earnout on that $1 million deal, where maybe you get paid $300,000 upfront, $200,000 first year, and then the remaining $500,000 or slightly less than that in that second year. Now, because you're already earning money in your business in the year you sold, you're probably still going to be above that theoretical 500K imaginary number I've just made up. So you want to consider that too. Like, how much did I earn for my business this year as I'm selling it? And can I create an earnout, some kind of calculation where I can get paid just underneath that threshold and then ride out the next 1 or 2 years with payments that come in the other way? Now, you don't want to do this, by the way, if you believe your business doesn't have long-term viability or you're in a business model that is highly volatile. So I would not recommend this strategy if you're a content site owner. Not because content sites are bad businesses. I think they're awesome businesses and become some of the best businesses in the world if you treat them right. Check out my 8-figure media empire series if you want to see how I would do that with that business model, how I would grow it. But with that said, SEO is extremely volatile and it gets more and more crazy and chaotic with the updates every month. So you don't want to put yourself in a position where you're relying over a period of 2 years or a year and a half on the Google algorithm with your earnout, unless you're in like an extremely big business, like a $2 million, $3, $4 million content businesses. Those are pretty solid and granted huge content sites. In that case, maybe that business is going to be around for much longer, right? Because it has such a good track record, it's probably a huge website, yada, yada, yada. There's a lot of good stuff going on with it, right? So make sure if you do an earnout, and this isn't even related to taxes, but just in general, if you do an earnout, make sure the person that's buying the business, you have the utmost faith in that they have the ability, the skill, and the desire to run the business. Because someone might have the ability and skill and their enthusiasm dies after 3 months of working on the business they just bought. And guess what? It's a earn out. So they might not have to pay you based off of the way you did the deal structuring if the business starts tanking or if it's not doing what was promised, all that kind of stuff. So you want to be careful here and make sure your business really has a chance to earn out with someone that is really going to pay you. Now, on the Empire Flippers Marketplace, the vast majority of earnouts go through just fine. We rarely see a problem. It's usually not a big deal. Sometimes there is a hiccup here and there, but it is very rare that an earnout does not get paid with us. And we make money off of that earnout too. Like, we take our commission out of that earnout along with the upfront sales amount. So if we don't get paid that earnout, we don't get paid either, so our incentives are aligned. We would never tell you, like if you use us, that is, we would never tell you to go and take an earnout for someone we didn't believe could pay you, right? That's just not our style. Even if we didn't get paid based off an earnout, we still wouldn't tell you to do that because that's just bad advice for you. And we want you to have the best possible advice we can give, right? So that's another strategy you can do, is structuring the earnout in such a way that can help minimize the overall tax bill. All right, so we talked a little bit about this tax bill. Again, there's a lot more details in the blog article down below, but one thing I want to leave you on with is the idea of selling now and reinvesting now. So again, let's use that $1 million example and say you only got to walk away with $600,000 of that at the end of the day. That's $600,000. Yes, you just paid a massive $400,000 tax bill from the exiting of your business, but can you make that $600,000 grow at a rapid pace? For most entrepreneurs, I say that answer is probably yes. If you built $1 million business, you're scrappy, you are bootstrapping, you understand how marketing, logistics, business in general works online, using that $600,000 to grow a new business or buy a new business, there's all sorts of things you can do with that money to turn that 600K into well over $1 million. And you could probably turn that 600K into a $2, $3, or even $4 million business over a period of a few years with your skill sets. That's my personal take on it, because I meet a lot of entrepreneurs who are highly skilled that if you give them $600,000, it's just like watching rabbits breed. There's a weird analogy, but you get what I mean. You're able to grow that pool of money much, much faster. So even with that $400,000, while it's a blow, it's not such a blow where you can't accelerate past it with your wealth. Now that's one take on it. The other take is the buy is just like not selling at all and holding. Now, in this scenario, you won't pay any taxes. Nothing really changes because you're just running your business like normal. And one final word on this tax thing is, if you look at the period of history from like say the 1900s up to now, there's been periods where wealth taxes have appeared and they've gone away. They appear and they've gone away. And it's really just on the mood of the day that could set the economy back by, say, 2 to 4 years with a plan like this before they, deactivate it. It's like, oh, that was a bad idea. Let's get rid of that. No one's selling now. That, in fact, I think it was in the 20s, maybe in the 1920s, where they did have a wealth tax that was very similar to what is being proposed right now. Now, this one is a bit more aggressive, though, in terms of its nuances, I believe, but the old one was actually more aggressive in terms of the actual taxation percentage. So the government would get a lot more money. The problem that the government ran into was basically no one was selling anything. And so they actually had a net loss on the taxation. So they might have been charging, 20% more, but they were actually getting about 5% of real tax revenue versus what they used to got, because no one wanted to sell. Instead, what people were doing was exactly what I just said earlier in this video, where they would get loans on their business, use the business as collateral or use their investments as collateral, and basically just pay, like their distributions would pay into that loan. And it was just kind of a weird money shuffling thing that, yes, they paid interest on those loans, but they were usually very low interest loans that allowed them to lead their life without ever having to actually have that tax burden, right? And that's still what a lot of people do today. But what happened back then, because it was such a huge hit to the tax revenue, I think it took them about 3 or 4 years, I think it was, to basically say no more of that, get rid of that. And once they got rid of that, guess what people did? They started selling their investments again, and tax revenue went up. So this is nothing new. This is just part of the cyclical nature of the economy and governments working together to try to figure out what is the best way to make this work, right? So there's nothing necessarily new here. To see the one major difference is here versus that plan I was just talking about from the 1920s, because one of the other strategies that the ultra wealthy did in the 1920s was they would just pass the investments on to their heirs after they passed away, and that was effectively passed through the tax bill, right? In this case, I believe it's called step up basis, I believe it is. This case, they're trying to make sure that doesn't happen. So even if your investment does pass to your heir, like I mentioned, now the heir would get taxed, and that could lead to actually worse scenarios depending on who your heir is and how tax savvy, business savvy they are, all that kind of stuff. And to be honest, most of us in the online world, we're still pretty young, like even the oldest among us when it comes to building our e-commerce stores and Amazon FBA businesses. We probably have a solid 20 years left in our work life a lot of the time. So whether that's a lifestyle design or a startup grind, Gary Vee kind of work mentality, right? But with that said, I wouldn't rest your laurels on the idea of passing your investments to heirs. I think that's a cool idea. I think it could get hit by this tax bill. But also, I don't think this tax bill is going to be around forever. If it does pass, maybe 3 to 4 years, like similar wealth taxes that have come in the past. I don't actually foresee it lasting that long, in the grand scheme of things, at least. 4 years is a long time for us, especially in internet land. But overall, it will be pretty a blip on the radar, I think, at the end of the day. I could be completely wrong, by the way. This might be just the beginning of insane taxes, right? But that's my own personal take on it. And by the way, I mentioned this at the beginning of the video. I'm just a guy on YouTube that works for a company that helps people buy and sell businesses. I am not a tax professional. I'm not an accountant, I'm not a bookkeeper, I'm not a tax lawyer, none of those things. So before you do anything related to this, my final tip is to go talk to someone who is. Talk to someone who is in the thick of it. And not just that, talk to someone who's in the thick of taxes related to your business model. If you are an e-commerce entrepreneur, talk to an e-commerce accountant. If you are a content site owner, talk to other content site owners, accountants that have sold their businesses that are tax savvy, or talk to a legal tax profession, a tax lawyer that is familiar with online businesses and the intricacies that it provides. Because online businesses can provide quite a lot of advantages from a tax perspective if you structure things right, with different kind of corporations, different kind of business entities, all that kind of stuff. So definitely talk to someone who's actually good at this, not the YouTuber, right? These are just some general ideas for you to start thinking about. But if you are in the camp of wanting to sell your business now because you're one of the entrepreneurs I mentioned earlier that can take that $600,000 and just grow it massively if you had that burning in your pocket, there is a link down below this description for you to do just that, where you can sell your business with the good old empire over here, and we'll be happy to list it, happy to put you into our database that has over $4 billion now in buyer liquidity to buy high quality businesses just like what you've built. Talk to you later. Bye.